Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Tracking down SBF. Citizen journalists spot Sam Bankman-Fried in the Bahamas as Caroline Ellison attempts to flee to Dubai. Everything you need to know. FTX Hacker Dumps. The unknown exploiter begins converting hundreds of millions of dollars worth of ETH into BTC. What effects is this having on these two cryptocurrencies? Genesis Global in trouble. One of crypto's largest trading firms tries to avoid bankruptcy while multiple US states investigate the company. When will we know what comes next? Binance Bailouts. The cryptocurrency exchange accumulates $2 billion to save promising crypto projects. Which projects are on the list? Oil shortages incoming. Russia warns that it will stop supplying oil to countries that comply with the upcoming price cap imposed by the United States and its allies. Why you need to pay attention. And another unique take on where we are in the market cycle by the one and only Benjamin Cowen, backed by overwhelmingly popular demand. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. As the FTX Alameda research situation continues to drag on, many are wondering how the founder and ringleader of both companies, Sam Bankman-Fried or SBF, still isn't behind bars. Even more people are wondering how it's possible that Sam will still be speaking at a public event this coming Wednesday. After all, Sam reportedly used up to $10 billion of user funds from FTX to prop up Alameda Research. This is in addition to buying properties using company money and all the other horrors that were revealed in FTX and Alameda Research's bankruptcy filings. More about that in the description. Now, despite all this alleged corruption, Sam has really received next to no scrutiny from the mainstream media or the establishment. This has effectively forced the crypto community to take matters into their own hands by going to the Bahamas to track down Sam themselves. There has been no shortage of photos and videos circulating on Twitter which claim to show Sam out and about, and in some cases, even running away from being filmed. The most famous of these is probably the photo of Sam and his parents just hanging out on the balcony of his Bahamas apartment. It seems that these photos and videos inspired other citizen journalists to join in on the investigation because over the last few days there have been dozens of photos taken around Sam's property. This includes Sam's Toyota Corolla car, which he claimed to drive as part of his supposedly frugal lifestyle. Some crypto crusaders have even gone as far as live streaming from outside Sam's Bahamas apartment, and good on them. In the absence of any actual justice, it's easy to understand how things have gotten to this point. FTX had millions of users, and some of them lost their life savings when the crypto exchange collapsed. If something is not done soon, any remaining hopes that those in the crypto industry may have in the justice system will be lost. Meanwhile, Alameda Research CEO Caroline Ellison has allegedly fled from Hong Kong to Dubai. This is peculiar given that Sam was reportedly under supervision earlier this month after he tried to flee to Dubai as well. I'm not sure why they think this place is a safe haven. There are, after all, many FX creditors here. If it's true that Caroline has fled, then it further undermines the credibility of the establishment, which claims to protect retail investors from these kinds of characters. I suspect it has something to do with FTX, Alameda, Sam, and others donating millions to politicians on both sides of the aisle in the United States. This is why many are wondering just how hard Sam will be grilled by US politicians when he testifies before them next month. If you ask me, Sam shouldn't be flying out to Washington. The only place he should be flown out to is a high-security prison and left there for a very long time. Anyways, the only thing crazier than Sam and Caroline running around is the fact that the FTX hacker has still somehow not been caught and is apparently starting to cash out. For context, FTX was hacked for almost $500 million worth of crypto shortly after the exchange went down. It was initially believed that Sam or another FTX employee had begun siphoning assets from the exchange to make a getaway. Shortly afterwards, however, Kraken's chief security officer announced that the exchange had identified the hacker after they'd tried cashing out using Kraken. Now, this begs the obvious question of who the hacker is, since they're still apparently at large. In any case, they managed to convert most of the crypto they stole into ETH using decentralized exchanges. This actually made the FTX hacker one of the largest holders of ETH in the world. Early last week, the hacker started to convert some of the stolen ETH into BTC using different kinds of wrapped Bitcoin. Specifically, the hacker swapped ETH for WBTC and then swapped the WBTC for REN BTC. This is because REN BTC can be unwrapped using REN protocol in a trustless manner. In other words, REN BTC tokens on the Ethereum blockchain can be redeemed for actual BTC on the Bitcoin blockchain without having to use a trusted third party. By contrast, WBTC requires exchanging WBTC tokens for BTC using BitGo, which would certainly prevent the FTX hacker from cashing out. So, the FTX hacker dumped tens of thousands of ETH worth tens of millions of dollars, and this made a predictable dent in ETH's price. It looks like the hacker was only able to dump so much, however, because they started splitting up their remaining ETH holdings into separate wallets. Speaking of which, you can learn how to keep your crypto safe using the link in the description. I digress. As for the stolen BTC, it's possible that the hacker has been swapping it for other cryptocurrencies using atomic swaps. The problem is that this would be hard to prove, as these types of complex transactions look like regular transactions on-chain following Bitcoin's Taproot upgrade from last year. Still, it's possible that some of this BTC is being converted into Litecoin, given that it recently introduced a privacy-preserving sidechain. This would actually explain why LTC pumped so much recently, and in my opinion, it's a much better explanation than the next Litecoin halving, which isn't expected until sometime next summer. It would be a logical move as well, given that there are as many or more points of withdrawal for LTC as there are for BTC. Regardless, it's clear that the FTX hacker isn't an amateur. It stands to reason then that they wouldn't be dumb enough to get caught by trying to cash out using Kraken. So this brings us back to the question of their identity, which remains unknown. One of the many mysteries of the FTX Alameda saga. Now, regarding ETH and BTC, the FTX hackers' move to swap ETH for other cryptocurrencies suggests that their selling could occasionally suppress ETH's price for the foreseeable future. It could have a similar effect on BTC, assuming the hacker is in fact swapping it for cryptocurrencies on other blockchains. Anyhow, the effects the FTX hacker is having on the crypto market are negligible in comparison to those caused by the uncertainty around Genesis Global. If you watched my video about Digital Currency Group, or DCG, on Coinbureau Clips, you'll know Genesis provides crypto trading services to institutions. This is why the crypto market panicked when Genesis announced that it had stopped withdrawals for its clients earlier this month. Since that time, the trading firm has been trying to secure the funding it needs to avoid bankruptcy, an amount that's believed to be somewhere between $500 million and $1 billion USD. It seems that Genesis has been having a hard time finding investors because last week it was reported that the trading firm had hired an investment bank to help restructure the company to avoid bankruptcy. At the same time, DCG CEO Barry Silbert finally broke his silence on the situation by explaining to investors that DCG had already bailed out Genesis when it lost $350 million from the collapse of failed crypto hedge fund 3 Arrows Capital, and basically wouldn't be doing so again. Barry simultaneously revealed that DCG itself was $2 billion in debt, which, although not that big of a deal given the company's $800 million a year revenue, definitely didn't help calm the situation. Recall that Grayscale, another DCG subsidiary, has also faced scrutiny about its Bitcoin reserves. Now, if all that wasn't bad enough, Genesis is reportedly being investigated by regulators in 7 US states, which allege that the company offered its services to retail investors. More importantly, the regulators allege that Genesis offered unregistered securities to retail investors. Now, this is significant because any cryptocurrency that is considered to be a security is at risk of a crackdown by the Securities and Exchange Commission, or SEC. As we've seen with other cryptocurrencies that the SEC has labeled securities, delistings and price crashes tend to follow. In theory, the SEC considers a cryptocurrency to be a security if the expectation of profit from buying the coin or token comes from an identifiable third party. In practice, however, it seems the SEC has been picking and choosing which crypto projects to go after. Seeing state regulators designate certain cryptocurrencies as securities could be enough to entice the SEC to go after these coins and tokens. The only problem is that we don't currently know which cryptocurrencies these state regulators take issue with. It doesn't help that Genesis offers them all. I'll be covering this DCG Genesis Grayscale Nexus in a video tomorrow, so stay tuned for that. One thing that is for sure, though, and that's that Genesis seems to be on its last legs. Without a fresh injection of capital, the trading firm will likely file for bankruptcy. At that point, whatever cryptocurrencies it has will likely be sold to compensate creditors, causing their prices to crash, and some could go to zero. The same is true of the cryptocurrencies held by FTX and Alameda Research. If you watched our recent update about Solana, you'll know that many tokens in its ecosystem are at risk of going to zero because of their exposure to FTX and Alameda. One of these cryptocurrencies that's at risk of going to zero is Ren Protocol. Now, you'll recall that the FTX hacker has been using Ren Protocol's trustless Ren BTC to swap from ETH to actual BTC. Well, if you watched our last video about the project, you'll know that it was actually purchased by Alameda back in early 2021. Unfortunately, Ren Protocol's high exposure to Alameda has resulted in the project only having enough runway until the end of the year. Now, this is extremely unfortunate because Ren Protocol is a genuinely good project, so much so that I once held it as part of my personal crypto portfolio. Fortunately, there are rumors floating around that Binance is planning on saving the Ren Protocol as part of its multi-billion-dollar crypto recovery fund. Now, this would make sense given that Binance seems to have a history of supporting promising trustless cross-chain crypto protocols. Thorchain springs to mind here. Speaking of Binance's bailout proposals, last week Binance CEO Changpeng Zhao announced that the exchange had doubled the size of the recovery fund, meaning $2 billion is ready to be deployed. What's interesting is that Binance isn't the only company that's contributed to the fund. Various crypto VCs and companies, including Jump Crypto, Polygon Ventures, and Aptos Labs, have collectively contributed $50 million to Binance's so-called Industry Recovery Fund. Now, this is interesting because Jump Crypto was one of the biggest investors in Solana's ecosystem. This suggests that some promising Solana projects could be bailed out as part of the fund. That said, Jump Crypto has also been a strong supporter of Solana competitors like Aptos, which were also affected. On that note, it's interesting that Aptos Labs has enough money to contribute to a crypto recovery fund when one of the project's largest investors was FTX. This suggests that Aptos has a lot more capital than perhaps meets the eye, and this could make it a serious competitor in the next bull market. As for Polygon Ventures, meanwhile, I suspect that it will push for promising crypto projects to build on Ethereum's most popular scaling solution. I say this because Polygon has a history of successfully reaching out to crypto projects and developers in the past, notably following the collapse of Terra. It's safe to say that whichever crypto projects get bailed out by Binance and Co. are likely to be high quality. Not financial advice, but I would strongly suggest paying attention to these projects going forward. I may do a video about them once capital has been deployed, depending on the circumstances, of course. Anyhow, before I let Ben Cowen take the reins, I want to cover an important macro factor that seems to have gone unnoticed by investors across the board. Next Monday, the United States and its allies will be imposing a price cap on Russian oil as part of their continuing sanctions against the country. If you've been keeping up with the channel, you might recall that the United States Department of the Treasury threatened to sanction any country that violates the price cap on Russian oil. Funnily enough, Treasury Secretary Janet Yellen warned of higher oil prices shortly after this statement by the Treasury. That's probably because Janet knew that Russia would likely respond to the price cap by stopping oil exports to any countries that abided by it. Lo and behold, last week the Russian government issued a decree that would ban oil sales to any country that sets a price cap on Russian oil. Now, it doesn't take a geopolitical expert to understand that this is going to force dozens of countries to decide which side they're on. For some, it will literally come down to deciding between being sanctioned by the United States or running out of energy because of Russia. That is not an easy decision to make. Common sense suggests that such countries will bite the bullet and side with Russia. That's because history has shown that a country can survive harsh sanctions, but it can't survive without energy, and Russia is one of the largest oil producers in the world. Some countries will learn this the hard way over the winter. And this ties into something else that's been overlooked, and that's the United States' Strategic Petroleum Reserve, which should start being refilled in the coming weeks. This will add to the demand for oil at a time when oil supplies are being cut both by sanctions and by the decreased production levels from OPEC. This will likely lead to more inflation in the United States and elsewhere. This in turn will cause central banks to continue raising interest rates to fight that inflation, perhaps even more aggressively than what is currently being priced in by investors. Such aggressive rate hikes would likely cause markets to crash further. Now, this of course includes the crypto market, which I believe hasn't yet found its bottom. Now, this is something that was mentioned by Ben last week as well, and his reasoning was that the apathy you see at the bottom of a bear market has yet to set in. We're all still very much focused on what's going on. I'll be doing a video explaining what else needs to happen before we see the bottom of the crypto bear market, along with how low prices could go later this week. For now, though, let's turn to Ben's amazing analysis of what he's seeing in the crypto market. So, take it away, Ben.
Hey Guy, thanks for having me back on the show. As always, it is a pleasure to be here. I'd like to spend a few minutes talking about something called the cryptocurrency social risk. Now, as we go through these charts, I just want the audience to know that they should always think twice, because I am not a financial advisor and this is not financial advice. What I'd like to do is just quickly talk about some YouTube and Twitter statistics related to cryptocurrency content and how we can combine all of that into a single social risk metric to help us better identify where we are within the overall market cycle. What you may notice on this first chart, this is YouTube subscribers to popular cryptocurrency YouTube channels. You may notice that back in 2019 and 2020, there was relatively little interest or new interest in the cryptocurrency asset class. Despite the fact that prices went up at one point 4x for Bitcoin, there wasn't a whole lot of new money coming into the space. However, you can see a lot of new market participants came in late 2020 and early 2021, and this helped support that bull market that we saw Bitcoin go through that took it up to about $64,000 back in early to mid 2021. We can also see a final surge back in late 2021 that potentially helped support the secondary peak. But again, this is a way to measure if there's a lot of new interest in cryptocurrency, or if we're in, say, like a bear market where interest in the short term dies down, but people continue to build and come up with cool and new innovative ideas to support eventually the next bull market. We can also look at YouTube views to popular cryptocurrency YouTube channels. And again, you see a very similar thing as we saw with YouTube subscribers, and that is a general major peak back in early to mid 2021 followed by a bear market ever since. This is one of my favorite social media charts for cryptocurrency, and that's Twitter followers to popular cryptocurrency analysts. This is probably one of the only charts that actually calls the 69K peak fairly well. If you look at most indicators, they will say that the actual technical top occurred back at 64K back in April of 2021. This is a metric that actually shows pretty clearly the 69K peak, and that's really well mapped with just new followers to popular cryptocurrency analysts. So again, this is a good way, I think, to gauge retail sentiment in crypto. And when it's surging and when you're seeing a lot of new followers all at once, that's generally a good time for early investors to become cautious. But when you see all of these tourists leave the space in the bear market, that's when the long-term investors come in and they can find pretty good value within the cryptoverse. We can also look at Twitter followers to exchanges and Twitter followers to layer ones and come up with similar types of conclusions. What I'd like to do to finalize this type of analysis is to combine all of this into one single social media risk indicator. And if you do that, you get something that looks like this. And you can see that it accounts for YouTube subscribers to cryptocurrency channels, YouTube views, followers to popular cryptocurrency analysts on Twitter, to Twitter exchanges, and Twitter layer ones. Okay, so layer one accounts on Twitter. And when you do this, what you'll notice is that we tend to just go through a period of apathy into a slow uptrend into a bull market with social interest, which tends to map out the price pretty well. And then during the bear market, this falls off pretty quick. And we go back into apathy. You can see 2018 was a bear market, and then 2019 and 2020 was just generally the accumulation phase before the next bull market. And you can see that the price increase was supported by all the new retail investors coming into the space and pouring money into all of these projects that the long-term investors who look for good value saw back in 2019 and 2020. But the truth is a lot of people only come in once the price starts going parabolic. And again, you can see that this risk metric goes from 0 to 1. We went up to these highest risk bands for the social risk back in early 2021, and then again in late 2021. And then ever since then, it's more or less just been in a downtrend. I would speculate, dubiously of course, that we're likely going to see new lows on the social risk metric as we get later into the year and potentially early 2023, and where we might see something not that dissimilar from what we saw back in 2019 and 2020, where you have this bear market, then followed by an accumulation phase before we get into a new bull market. Again, these things just take time, and a lot of new people like to come into the space when the price is parabolic and everyone's talking about it, and then it just takes time for the tourists to leave. And then once again, the long-term investors who actually see the real value within crypto, they come back in once again to support the asset class, and they can find various good value deals during the accumulation phase during that period of apathy. And I like to remind myself that markets bottom on apathy like they did back over here in 2018 and early 2019, not when everyone is tuning in and asking if the bottom is in. Hopefully this provides some good insight into the cryptocurrency market. Thanks again for having me on, and I look forward to seeing you again next week.
Thanks, Ben. It's great to get your take on things. And hey, folks, if you're still here, you're not letting apathy win. Good on you all. Keep flying the flag. And that is all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're planning to maximize your gains during the bear market, the Coin Bureau Deals page is where you should go. You can find the link to that resource and many others in the description below. Thank you all so much for watching, and I will see you in next week's episode.